And so for today's workshop, this is going to be obviously the first workshop, and it's going to be how to draw gaps, hosted by myself, of course, and it's going to be a live discussion plus a Q&A. For those of you that have questions as I'm going on, please just either ask in the chat, in trading chat. I really don't like that live trading chat because I never like noticed it when people ask questions because it doesn't just like pop up on my screen. So if you guys can use trading chat, that would be suggested and highly appreciated. And also, if you feel free to just ask questions, unmute yourselves as well if you guys have a question when it comes to this. Okay. All right. So let's begin the workshop. How to draw gaps, live and Q&A. All right. So. Pretty simple. I don't want to go into too much. I'm going to be having blank charts, and I'm also going to be using just the standard colors with a green and red color, right? And let me actually go to the first example I actually wanted to show, which is XLC. All right, so a common misconception about gaps, and I do not blame people because this is what I thought about gaps as well, is that when you see gaps in price, the most obvious ones are the ones where you can see, like, you know, literally a gap in price. All right, so you see this candlestick right here, like, oh, okay, this is a red candle, and obviously we trade the strat, so this is a 2 down candle, and then we had immediate 2 up candle, right? So right here is a gap. We're like, oh, okay, definitely we see that gap in price. So like naturally, if we want to mark our gaps, we put like, and this is how, remember, this is how I'm doing it. I'll put like a horizontal ray right there to mark the bottom of the gap, and then I'll put another horizontal ray to mark the top of the gap, and then I'll also shade the gap, right? So I can understand that, all right, these are the gaps, okay? And what I do is that I name it, I don't know why I named it P gap, but it's just, I've always just had it there. So gap fill, boom, all right, cool. Wick to wick, there's your gap in price. Now, this is where the problem actually occurs, because actually this is not where the gap is created, right? The gap is actually bigger, and the reason why the gap is actually bigger is because this goes back to the whole topic or the whole discussion of each candlestick tells a story. All right, so we understand that we use candlestick chart patterns, and we understand that we have a high, we have a low, we have a close, and we have an open of the candle. All right, so I'm just gonna mark this real quick. Got your high, open, this is, yeah, open, close, low. Okay, so pretty self-explanatory. Open here, and also the color of the candle really actually helps you understand what's going on. All right, so when you have a red candle, you know that the close is below the open. All right, so you open at the higher and then you close below. That's what makes the candle red, right? And if you have a green candle, the open is going to be below the close, so meaning that the open is going to be down and then the close is going to be above, right? Meaning indicating that you went up in price, or that the price closed above its opening price, which is why it makes it green. So with that being said, because of the fact that this is the close, okay, this was the close, sorry, because this was a close at 4 p.m. all right, Eastern time. This is where you have to pay attention to, okay? Because the next day you can see that for XLC, or the communication sector, we gapped up in price. All right, now remember, we're going to mark the high, the high, low, and the open and the close as well. Okay, so you got your okay, right? Now remember, because this is a green candle, this is where you opened, this is the low, this is where you the high, and this is where the close was. So I'm going to mark the open. Boom, 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 boom. Okay, so this is referring to the open at 9:30 a.m. Eastern time, and this is referring to the close at 4 o'clock p.m. Eastern time. All right. Now, when it comes to the gap fill, when we talk about each candlestick telling the story, you have to understand what actually occurred in price overnight, right? Or what actually occurred from 4 p.m. Eastern to 9:30 a.m. Eastern. We close at this price. I'm going to mark a horizontal ray for you guys right here. Okay, so we closed at the price of $45.96. That's where we closed. And we opened at the price of $47.81. All right, so hopefully that makes sense so far. And I'm going to be taking these lines off so you guys can see. Okay. All right, so we closed at 4 p.m. Eastern at $45.96, and then we opened at $47.81. So in actuality, when it comes to the gap, right, the gap in price is from the close at 4 p.m. Eastern to the open at 9:30 a.m. Eastern. That is where the gap is created. So how I do it, right, is that I literally, you can mark it from the close to the open. This is your gap in price. Now, what else is going on after that gap gets created? You have to understand that intraday at price action is going to be happening, right? This wick right here is very important because this wick happened intraday during Thursday, November 10th, okay? So what happened is that you gap in price at 4 p.m. Eastern, then you open right here at 47.81. Then intraday price comes down to a low of $47.35, right? Because price comes down to a low of $47.35, it is trying to fill its gap that it created right here. So what you can proceed to do is that you can start condensing your gap, all right? Or filling in your gap, so to speak. So now you know that the gap in price is actually from $45.96 to $47.35, okay? And now I'm going to show you two examples side by side where you see this real quick. Okay, so remember, so in this example right here, let's go from the origination of the gap, or where the gap, when the gap was created. So right here, right, that's where the gap was created. So the close at 4 p.m. Eastern to the open at 9:30 a.m. Eastern. And remember how I said that you have this wick that was created intraday on Thursday, November 10th, that starts to fill in the gap, all right? So this wick right here, or this space right here, I should say, that is that space intraday that I was talking about, right here on the 15-minute. So remember how I said that we created this wick? And so now, if you were to move that gap, put it right there, you can see now how the gap is now from $45.96 to $47.35. Why? Because intraday at the open, we went down to try to fill in the gap before price went up. Okay, So remember that the gap, and if you look at the 15, this is why it's important. You can see right on the lower time frame, this is where you're going to see the gap. Okay, on the lower time frame. Now let's look at other examples. Another example right here. This example right here. Okay. So each candlestick tells a story, right? So for this candle, you have your close. This is referring to Tuesday, October 25th. You have your close at $51.81. You had your open at $50.74. So a green bar, right? The next day, you gap down in price. The next day, you from $51.84, you gap down to the open at $50.58. Okay, so there is a gap in price from here, the close, to the open, right? Okay, so there's a gap in price from the close to the open. And if you were to go to a lower time frame, you will see that price gap. Now TradingView kind of sucks because when you go to a lower time frame, they kind of have their bars like a little bit off, but just understand that like if you're looking at the daily time frame, whatever the close of that candle is, that's where it is, but you can literally adjust it, right? So you can adjust that. Okay, so you can adjust it right there. And so from the close, see how this is the close of Tuesday, October 25th, and then the next candle is Wednesday, October 26th. Look where we open. Okay, price opens right here. So from the you gap down in price, and so this is the gap right here. But then if you go back on the daily, you can see how so that's the gap from the close to the open. And then you can see how intraday you have a wick, right? So this wick was created intraday trying to fill in the gap. So if I move the gap right there, boom, right? Boom, gap fill there. Now, if I go on the 15-minute from Tuesday, October 25th to Wednesday, October 26th, look what happened. There is your gap in price. Okay. Because it gapped down from here. Originally, it gapped down from here to here. Then intraday on the 26th, we tried to fill it a little bit. Filled it, filled it, filled it, filled it, filled it, filled it, and eventually just got up to here or went back down. Okay, and so you still need to fill this. And so now, what is the importance of gap fills? The importance of gap fills when it comes to my trading style is that because of the fact that gaps like to get filled because of it's an imbalance in the market, there's a saying that not all gaps get filled. Yeah, not all gaps get filled, but how I like to think of it is that if you're next to a gap, the likelihood of you wanting to fill that gap is high. Also, the likelihood, but you also have to realize that gaps can also be used as supply and demand zones as well, right? So for example, price can get to the gap, and then it can reject it, okay? And the reason why I can reject it is because that gap fill is seen as a supply. More times than not, it's going to try to fill the gap, right? But you just don't know when it's going to try to fill the gap. If you're next to the gap, the likelihood of it wanting to fill it, at least for my trading style, is high, but I also understand that gap fills are used as supply and resistances, supply and demand and support and resistance levels, right? So that is why you will hear me say, or you'll look at my trading alerts and I'll say, we're approaching the gap, make sure to take profits, because sometimes that will literally be the end of the play for that day, and then it will be a hard rejection. but at least you trimmed right when you're approaching the gap. All right. And so what I do literally for every single one of my charts is that I mark all the gaps for price. So I look back in price and I'm like, all right, so we just filled this gap, right? And remember, the gap started from here, not here. And you also can see that even the chart even told you like, oh, this is our target, gap fill, boom, you wick there, right at the gap fill target. Gap fill target, because this is where we started the gap, from here, and then it closed here. Okay, so we filled that gap. Now where's the next one? Okay, you have a gap right here. I also look back in price. We also have a gap here. We closed at the top of the candle and immediately gap down the next day. We gap down to the open, and then intraday we try to fill it. But now mark those levels. Mark it. Mark it. Gap fill. Next one. This is one right here as well. You close at this candle and then you opened here and you try to fill it. Mark the close. Mark the intraday fill. Gap fill. Mark every single one of your gaps. Why? Because they're potential targets. Okay. Let's see if you have another one. Right here. Close 4 p.m. Eastern. You open 9:30 a.m. Eastern. Try to fill it intraday. Gap fill. Market. That's a gap. Price. Okay, I'm gonna take these off now because I'm pretty sure you guys get it. Yeah. So any questions? Any questions? Let me see. I'm gonna check the chat in just one moment. Yes, it is being recorded, Paya. Thank you, Julia. I appreciate you so much. Thank you for having this this picture, because this is literally explains it. The high, the low, the close, and the open. That explains everything you need to know. And that's why, like, for strat, you know, we're not really paying attention to the color of the candle. Well, I guess, yeah, we do. But for the gap fills, you really want to pay attention to the color of the candles, because you need to know the high, the low, the close, and the open. This is very important, right? This right here is very important. We had a high, we had a low, we had an open, and we had a close right here, right below it. This close, from this close at 4 p.m. Eastern to the next day to the open, right? And then you try to fill it intraday. That is where the gap is. And if we go on the 15-minute candles, right, you will be able to see it. The gap, gap, or gap. All of these imbalances that we have to fill. We just filled this one. Okay. This was the intraday gap that we created going from, what was it? Thursday to Friday? Yeah. You ever use this approach on the weekly time frame? Is a daily time frame best for identifying gaps? Yes. Chris, the daily time frame is the best way to identify gaps. And Julia, to answer your question, you can see it on the weekly, but it's going to be harder. So this is that's a great, let me show you. You go on the weekly, right? So if you look at the weekly, you can see, and this is why, like, you have to go to those lower time frames, because on the weekly time frame, you won't see those gaps there, right? And the only gaps that you're going to see are the ones that are like big. So like this one, for example, this one is a gap on the weekly time frame because this literally gapped down from Friday to Monday. Yeah, that's what it is. I think it's literally from Friday to Monday. Market real. Yeah, Friday to Monday. Yeah. So the ones that you see on the weekly time frame, because those are the ones that are created from Friday to Monday, right? And so mark those close of the week to the intraday fit, or I guess you could say intra-week fill, right? And then you could see that right here on the daily time frame. You closed on Friday right at this price, and you opened at this price. Let me mark that. You opened at this price, the open, okay? And then you could see that on Thursday, we tried, what was it? Monday, Tuesday, Wednesday, Thursday, Friday, no, Friday. Friday, we tried to fill the gap a little bit. And so that's very important. Let me actually highlight that. So you see how like this weekly gap right here on the weekly time frame, notice how it didn't try to fill it until 4 days afterwards, right? And so that's why you have to mark it and see like, oh, there's a gap in price, but no, okay, where is that wick? Means that we tried to fill it either intraday or intra-week, and then you want to mark that and then mark your gaps as well. Okay. All right. Any other questions so far? That was pretty much the presentation. Hopefully it makes sense. Remember the open, the open, the close, the high and the low of each candlestick. You're not marking it from wick to wick. You're marking it from close to open, and then you're proceeding to fill it as it like tries to fill it intraday or intra, whatever time frame you're looking at, intra-week or whatever. Okay, close to open, and then you fill it as it tries to wick, like the intraday wick. That is very, very important. And you use these gaps as potential targets. If I go to my, I did this, oh, a lot of you weren't, a lot of you probably weren't listening to me, or you could probably already logged off at 1 p.m. Market close yesterday, but pretty much I was just showing like why I love my gap fill targets, because like, remember I said Tesla I wouldn't get out until it got to the gap fill, and look at what happened. Like it's like bread and butter. Like Tesla, gap fill target to the upside, inside day hammer. Where am I going? Gap fill, easy. Lucid, inside day hammer with the gap fill target to the upside. Where am I going? Gap fill. What else? Was it Cat? We didn't quite reach the gap, but we've been reaching all the other gaps though for Cat. Like we've been filling all these other ones. We filled this one. We filled this one right here. Like I've been marking all my Cat gap fill targets. Cat got another gap right here at 240. Right here, see? What else do we take? Oxy. Like I'm telling you, inside day. If you guys want to know how I pick my setups, I just look for gaps. Oh, you have an inside day and you have a gap to the upside, boom, gap fill target, you're in. And you know what's crazy? Like they'll come seconds away from filling the gap. Seconds away. They'll literally come like dollars or cents away from filling those gap fills. Like that's literally like how I PFE gaps. Just mark all the gaps. Gap fill, next gap fill, $48. Reason why I want Valero, look at the gap to the upside. Once you break up this supply zone, gap fill target. Gap fill targets are literally the cream de la crop. Oh, AMD. Why did I want AMD? Because remember that gap fill right here. And we completed it. SMH has that gap fill to look like it just, these gap fill targets. DE has a gap to the upside as well. Trying to get that as well. All right, so any other questions? Do you look at the gap for all time frames? So I mostly just, because the daily is more visually, like you can easily visualize it on the daily. That's where I'm looking for mostly. Like if I'm looking on the weekly time frame, I can probably see it, like see, like this is an easy gap on the weekly time frame. That's like hella obvious. Boom, boom, that's a gap right there. Then we filled it. This is a gap right here. So rotation packages. So yeah, yeah. Hope you guys learned a thing or two. This is gonna be my how to draw gaps workshop. Any other questions? What I want you to do, you already know. I'm telling you guys to do your homework. So what I want you guys to do this weekend is to literally mark all your gaps for your charts. As all the charts that you're gonna look at, you mark all the gaps, because I'm telling you, they're easy targets. You know, we're now in a downtrend. Look at those kicker pattern gaps that we created. Like, what was the kicker? XLC. Go back to XLC. Right, like, so we created that kicker pattern gap, right? Remember, and so now when we go back in the downtrend, you can use that as a potential target to the downside. All right. Okay. All right. Any more questions? You guys have?
Adex?
Yes.
Hi, good morning. It's Julia.
Good morning. How are you doing, Julia?
I'm good. How are you?
Good.
I have a quick question.
Yes.
When the gaps are really big, do you divide them like in half or by 4, or do you use the standard pivots to then become targets, or how do you navigate through that?
Okay, so Walmart is a beautiful example. Walmart has a huge gap from 143 to 148. So this is how you can do it. So I draw my fibs from the close to the point where the gap was filled, right? So to the nearest point where the gap was filled. So ultimately, so we gap down from here all the way down to, like, I think we gapped down from, what is it, 148 all the way to 136. But you see how we started to fill that gap now? So the original gap was created from here to here, and then now we started to fill it. And so now the rest of the remainder of the gap is from here to here. So what I do is, as I keep adjusting my gaps, and if it's a large gap, I'll move my fibs, right? And I usually only have the 50% fib, right? So for Walmart, I would have the 50% fib. But if you're looking for other price targets, you can have like the other fibs as well, like the 0.25, the 0.382, the 0.5, the 0.618. But for myself, I'm using pivots to find my other targets. So for example, I'll go on the weekly, or actually let's go on the monthly, because I know the monthly is stronger. So I'll look at, okay, so this is a price target. Boom, monthly pivot. Another one. Monthly pivot, monthly pivot. I go weekly pivot. And so now I go on the daily. Now I have targets within the gap. I have a target right here, I have a target right here, I have a target right here, I have a target 50%, target right here, target right here. I do now, I can also have, like, because it's a daily time frame, so I can also do, like, mark these pivots too, pivot. But because it's in a gap, I would rather take it at the stronger pivots, which would be at the weekly, monthly, and up, if that makes sense. Hopefully that answers your question.
Yes, it does. Thank you.
You're welcome. Okay, and I'm gonna check out Oxy real quick for option trader. So we started to fill the gap on the daily. So remember, I'm telling y'all, inside day with full time frame cotton, like when I say the strat will tell you where we're going, like if you see an inside day with the hammer, with full time frame continuity, with the gap to the upside, you got a target. You literally got a target. Like that's your target. Tesla, when like in live, when Abby said, oh, bottom of body formation, I was like, oh, 312 to the gap. To the gap. And what helps me when I know I have my target there, it helps me stay in the play, right? Because remember Tesla came off of a hammer, so buyers were here, right? So if I initially had a bias that buyers were here and I have a gap fill target to the upside, and the strat is telling me you have the potential for a 312 see it later off of a bottom of a BF, I'm gonna have a bias to the upside. And I'm going to remain in that bias until the bias tells me, no, it's invalidated. What would invalidate the bias? 312 down. Did we go 312 down? No. And so that's why it's like, when we talk about like being confident and having conviction in the setup, why did you take Tesla? I took Tesla because Abisai said there is a 3-1 on the bottom of a BF. The bottom of a BF tells me that the risk to reward for the bottom of the BF is that I have a better reward going long, right? Not only that, we had our first green day after going 1, 2, 3, 4 green days, red days down, right? I also have a gap fill target to the upside. I'm also a hammer, and I also am coming off of a Momo hammer as well. Like there's literally 5 to 6 confluences that tell me to play calls, and the only thing so there's 6 confluences that tell me to play calls. What triggers the confluences? 2 up on the day. So it's like you create your checklist, and then like this is how it is. I create my checklist in my mind, and then like think about like a firing range. What fires off the checklist? The trigger. Once you trigger, boom, 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 boom. Now all the checklists activated, right? Everything in your checklist has now been activated. Now what deactivates the checklist? The invalidation level. What invalidates the level? 312 down. Because if it doesn't go 312 down, what else can it do? 311 or 312 up. And your checklist is still valid. And that's why it's like, create the checklist prior, and then literally what will invalidate the checklist? The technical level will invalidate the checklist, not negative 80% down. No, the technical level will invalidate the checklist and theta. Because I had the $200 cons, and obviously because it didn't get to 200, that's why theta negatively affected the contract and expired 0. But in terms of going to where it needs to, like where is price going? Y'all know where price is going, and that's why I say, like, for you guys, I say, like, where is price going to? As long as you know where price is going, then you figured out the game plan. Then now it's just a matter of picking the right contract, because you know where price is going. And if you draw your bars on the end bar, we would have held a 0.6. Yep, you're right. 0.6 fib demand. And so, like, I promise you guys, like, trust me, I look at AMD and I'm like, that's crazy, bro. Like, you were in AMD like right here. I was in AMD right here, or like, yeah, I was in AMD right here, and I said gap fill target is my target. It's just a matter of time, right? And then look what AMD did. Like, I was, even though, bear flag, oh no, we're in a bear flag. So I'm like, bro, trust the strat, bro. Trust the strat over patterns. Like, because look, gap fill target, I won. I like to say that I won because I said AMD is going to $65 in 2 weeks. AMD went to $73 in 2 weeks. Say that. I want you guys to say that I won. The play went in my favor. I was right. Because it's going to give you confidence in the next play. So when I look at the next chart I'm looking at, I'm going to win. It's just a matter of time. But you look at the fuckery that happened. And this is why I'm like, the market will pay you, but you just gotta be patient. AMD said, you just gotta be patient with me. You just gotta be patient with me. You just gotta be patient with me. But if you patient with me, I promise I'm gonna pay you.
I mean, if you look at it too, it had higher lows that whole entire time too. So there was no really thing where it invalidated.
The reason why I got out just because of CPI, that was the only reason why I got out. But,
I mean, that's a very good reason why.
yeah, but like in terms of the technical setup, like, and this is why I love ICT folks and that market structure shit. I didn't really realize the importance of like, yo, you're creating higher lows. Like, this is a higher, I didn't realize like, yo, because it's creating higher lows, like that's up. That means up. Like, it means it's going up. Higher low, another one, higher low. Like, it's
don't you think that's crazy though? How if you drill into a smaller time frame, you can see or visually see like where the higher lows are occurring, but when you're on like a larger time frame, it looks like a bear flag, which is why I think like perception is important and why multi-time frame analysis should be always incorporated. Because to some, this would have been super bearish. To others, this would have been very bullish. So, like, just something to add to that.
It's really important. It's really important, y'all. Like, I really am fucking with market structure. Like, understanding, like, yo, once you get that displacement candle, like, that's what happened with SPX on the 15. It's like, once you got that displacement, or no. Oh yeah, so for me, right, the reason why I said like look at SPX is because you had 1, 2, 3, 4 candles down, then you had your first candle that was green, and then you just literally proceeded to create higher lows. And then because of that, that tells you like, oh, the trend is up. Like, you can come down, but as long as it's creating a higher low than like either the previous or like the previous, like, I guess, market structure, higher low, whatever, then you know that it's still going up, if that makes sense.
And when you look at both of those outside bars that you have there, the one I think on the 11th and then the one at 10 o'clock, you have those two wicks, which is literally just a liquidity grab. You come up and then you come back down, and then you have that other wick, which is literally just testing your structure, and then you have the reversal.
Yep.
So you have your run, you have your retracement, and then you have your expansion.
Yeah, it's beautiful. I think it's freaking beautiful. Like I really like it. Like,
I'm still learning it, but it's insane. And then you just draw your 50% fib, and that's all you got to do.
There are 2 requests, one for Meta and then one for the Tesla broadening formation, if you haven't already covered it.
Okay, Tesla broadening formation.
They said, or Chris asked, invalidates 312 down on the daily closing price question mark. And then you have the Meta gap that.
Wait. So where's the 312 down? Which one?
I think they were talking about Tesla being the 312 down on the daily.
Yeah.
Okay.
And they wanted to see the broadening formation for
it.
The broadening formation. Okay.
But if you dive into the 15-minute on Tesla, you can literally see that all I needed to do was fill that fair value gap, and it just bounced.
Okay. And actually, let me do it on this so you guys.
I didn't even realize Tesla had an actually decent green candle. Should be good for reversal in this coming week.
We're not reversing, baby. We're going to the moon.
Chill out.
No. Look at this. Look at who's bearish now, and look at who's bullish.
So you see, for those of you that are like, why was Tesla? Look at these wicks. Like, shout out to AdexTrades for the wick. Look at these wicks. Like, Tesla comes here, boom, bounce. Tesla comes here, boom, bounce. Tesla comes here, psych, see you later. No, we're not even coming down. Tesla comes here, boom, bounce. Like,
it's
and then
almost like it doesn't want to break its structure.
And then look what happens. See, and you can connect, like, I can connect it from these two.
I think a better visual of the weekly broadening formation index is if you use that current weekly candle, let it close that, and then use those other wicks like slightly before it, like in the June. It looks like it's in the June time. Like, you see those wicks above? Like, yeah, I would connect that.
I use these ones?
Yeah, because that's more near term. You know?
Hold on. Because the daily, I saw the broad information on the daily. 1 second. That one.
You see how that works on the daily though? Like if you're using the short term, like yeah, you can like broad informations exist everywhere, but
so yeah,
I would personally go from those lows to that recent low, or even go even closer. It just depends on your perception and like it's relative to like the time frame that you like using the best. I mean, there's no right or wrong answer with broad informations, guys, because broad informations exist literally everywhere. You could find one on the 5, 15. You can expand out.
Yeah, so I use this one, and then I use this one, and you could also use this one. Right? So you have like 3 points where bonding formations are connecting, right? And so all you're doing is literally looking at the risk to reward. The risk to, like, you get the first green day after going 1, 2, 3, 4, 5 days there, and you got an actionable signal, and it's a hammer. Like, and it's a hammer. Like, if anything, the hammer should have told you, oh, inside hammer should have told you, oh yeah, you know where we're going. Like, bulls. And so your risk to reward is literally, and y'all know how bonding formations work. You can do another bonding right here, boom, right? So your risk to reward for the setup, and we know Abisai got a long dated call for Tesla. Why? Because he said, oh, my risk is this, but my reward can be this. And if Tesla want to all of a sudden do some fuckery, or no, go like this, all right, that's the risk to reward. You're risking this much downside for this much potential upside, and all you need is time.
And it's also something to pay attention though, like on your broad information, like if you're trying to find it, a good way is to just, did we make new lows previous to the lower lows that we had? So like if you're looking on the daily, like where ADEX has, like if you go back to like the 17th through the 24th or whatever.
Of what? Of 17?
Right, yeah, right there, those candles right there.
Okay.
You see how you make a new low there? That's a broadening line. Look how it bounces. Right? So buyer exhaustion and seller exhaustion exists, and that's why these broad information lows, broad information highs, or if you're just using market structure, like you have lower lows or you have higher highs, you can kind of get an idea where this exhaustion is going to potentially take place. And like a good way to kind of identify when it could bounce is you'd look for those those larger wicks, or you finally get some kind of green 2 up or red 2 down if you're at the top of the broad. And then from there is where you can identify your risk, identify gaps, identify obvious wicks to the upside or downside to kind of understand where price could gravitate towards. And remember, it's always seeking liquidity. Where is liquidity at? That's one of the main things you guys should also be marking on your charts, is these obvious areas of wicks, these obvious areas of where price has struggled to get above or get below, because that's where you have a large concentration of liquidity, and price will most likely gravitate towards that. And so Tesla has a new lower low on the daily at a 3-1, 2 up.
Y'all know what the 3-1-2 see,
Yeah.
like that's why I say, yeah, remember, and that's what I'm saying. The strat setup would tell y'all. It says a 3-1. You know what a 3-1-2 see you later looks like. You know it means 2 up, 2 up, 2 up, 2 up. So if you know that's what it looks like, and if you're gonna anticipate it doing that, do you see how now you start to create the formula in your head? Like I literally said, oh, Tesla got a 3-1-2 see you later, and now look what it's doing. It's literally, if it goes 2 up on Monday, 3-1-2 see you later. But how did I know that? Because of the 3-1.
And if it pulls back, the key is to respect that broadening low stop. Because we know if this broadening low gets taken out, we're probably going to make a new broadening low.
Yep.
So that's how you can identify your risk in swings of, kind of trying to knife catch things like this. But we already had some kind of reversal on the daily. So now the continuation is whether or not we could see the weekly pivot flip up and stuff like that, and see the continuation. That's where you can use multi-time analysis, because look at the weekly still shows conflict, right? The day is green, but the weekly, monthly, and all that is not. So you're still fighting trend on Tesla. So you need to also pay attention.
Nice hammer.
Yeah, and you just need to pay attention. Okay, that's our weekly pivot. that's where Tesla needs to, see more upside. And that's how you can use those pivots, multi-time frame analysis and all that to kind of gauge, the magnitude of how strong a broadening low or broadening high bounce can ultimately become.
And so
if you give yourself time, you can sometimes even be a part of the entire freaking broadening swing low to swing high.
Hell yeah.
Because it happens. And if you're part of that, you get paid really well.
Get paid. That's how we took Costco off the double inside bar off the broadening. Like, literally, that's how I took it. Like, double inside off the 2 week off the bottom of the broadening. Like, this was we touched the broadening, and then we did a double inside 2 week off the broadening, and literally Costco said, this is the low, we have the potential to go here. That's all I needed to know.
Yeah. And then so, also, like, for the Costco is like, you see how your stop would be the bottom of that broadening low? Yeah. Look how it never came back. If you give yourself time, like, this position is still probably really well in the green, right? Look at that risk to reward. Broadening lows and broadening highs, I think, in my opinion, on large time frames like the daily and the weekly, I think they offer the best risk to reward. If you can identify them when the broadenings are occurring, and like you may be wondering, okay, but how do we know the broadening is going to offer some kind of bounce? Well, you don't really know, but that's where you assess your risk to reward, right? Like, this is what I'm risking, that's my reward. If it bounces, I get to be a part of it. If it doesn't, okay, I get stopped out.
DPZ, look at the wicks. Wick on the 2 week chart. Then you had then you had two more wicks at the 2 week chart. So this means that this was the demand zone for 4 weeks, right? So DPZ will either go consolidate to the right or go up. The wicks matter, and it's at the bottom of a broadening.
So powerful.
They're so powerful. Look, wick here. So this level right here, hold on. They're like, nah, we are not going to allow you to get below here.
Guys, the importance of wicks, like if you're brand new, like just to reiterate, is like, remember each time frame is giving you a visual of the auction per that given candle, right? So on this 2 week chart, we're able to see what happened over the duration of 2 weeks, and the candles are pretty much telling you a story, right? The wicks show you aggression from either buyers or sellers, and here you can see DPZ almost every single time you've had weekly wicks on the 2 week. Buyers just come in and just ramp it right up. Like if you look at the weekly hammer before that, same thing happened, right? It gives you a good visual in terms of what's happening in like, the auction for that given security or whatever. Wicks are super powerful. Why are buyers still buying it up? Why are buyers coming in at these specific areas? What areas are buyers coming in? And this works for sellers too. I'm just using buyers as an exhaustion because, anyways, but yeah. It's just a good idea to understand candle structure as well. Candle structure is very important because it's all telling you a story. Everything plays a part. Why are we wicking here? What's going on? Are we at a demand zone? Are we, at support? Is it a broadening low? Do we just have news? Are news coming out? So it's just a good way to kind of chart as well and pay attention to repeated wicks especially. That's when you can kind of get an idea of, okay, sellers are definitely giving up here. We've had repeated wicks. What's going to happen? Okay, buyers take over.
And then once you buy time, like when Eddie said he took FedEx, like this was like FedEx, he took it at the beginning of the month. But this is just one of those, like, as long as you didn't break structure, look, we're just creating higher lows on the time frame, and then boom, blast off. As long as you have time.
Dude, that's crazy.
Blast
really
off.
Dude, congrats. If FedEx fills this gap and you guys are in your swing still, y'all are gonna retire.
Dude, I would, like, if I would have known.
Eddie's still in it, right?
He's in 12/16, bro. I'm in 11/18s, bro.
Is he up like 2,000%?
Bro, he's $10 in the money with 6 weeks left. That's why, that's why when I'm talking about picking contracts, and Rob, like, I can't wait to have our class. Like, dude, when I'm talking about, like, you can be in the money and you just let it just ride. Like that's what I did with Costco. Like $500 calls and just let it ride to 540. Like just with time, you literally you don't have to trade anymore for the whole month while it's still like, going up. Like,
and even if you're early, guys, like even if you're early on the play and like it never like, you know, goes against you on the charts, like you don't have to fight against the Greeks. Like a lot of people are playing weeklies. Yes, weeklies may offer better reward, but the risk is a lot higher, because then now you're playing against things that you don't have any control over, right? You could play a month out and size in accordingly if the play, you know, goes back a little bit and your entry wasn't optimal. But like as long as everything stays intact in the chart, like you can make more money with time. Kind of what I'm trying to go at. And you don't have to go against these Greeks and things that, you know, you can't really control the outcome of.
And
like that.
And another thing, the reason why I love the fact, because when I would swing and I would say like, oh, I'm down 80-50% of play, people didn't believe me. But now you guys have definitely been in the swings where it's down 40-50% and you guys see it for yourself. So like AMD was a perfect example, and like shout out to Chris because you took that AMD play. I know you saw -30, -40 while it was just doing all, you know, the consolidation. But as long as it didn't break structure, what Abisai said, that you can actually get paid more with the ones with time. Like, because like think of, that's why it's when OG says like buy, I don't know why traders don't buy 30 to 45 days regardless, because it's like it literally checks all the check boxes. It checks all the check boxes. Like you have time, so you're not really worried because you have time. You're not worried about you being down 90% if you're in, because in contrast to a weekly that can easily see 90% just with a 2-2 rev on a 30-minute candle, right? And also like it's yeah, the premium is more expensive, but when it hits, you get paid more. Like, you know what I'm saying? Like AMD 500% is like what's $500-$600 a contract or something like that. Like you get paid. Like Rob, he buys 3 months out, and then when he hits on DE, like he's up like $3,000-$4,000 a contract, where I'm up like $600-$700 a contract. You know what I'm saying? And he bought more time. So it's like there's really no like there's no I would love for someone to tell me the negative to buying time, because I've seen no negative. Like
there's no negative, and the huge thing is because when you buy a shorter time frame and you move in the money, your intrinsic value is still less than your extrinsic value. So when you have more time, you have more intrinsic value within that contract, because the chance of price remaining within that contract at that level is greater than your out of the money extrinsic value that is a weekly kind of thing.
So and that's why I say, if you guys hear me saying, oh, I'm getting a weekly, get 2 weeks out. Like get 2 weeks out, because you know why? You know the reason why I'm like, oh, 2 weeks would have like paid, because how many times do you see a play, you get a weekly, but then the next week it runs? But so if you just had that one extra week, right? Like, because there's no disadvantage to having time. The play may have just like went 2 up on that week, but then the following week it went 2 up. You get what I'm saying? Like, so there's really no disadvantage to buying time at all. I know as degens, because I'm a degen myself, we want to see the 100% weekly, 200, 300, 400% weekly, and it's cheaper. But really, if you really want to like maximize and conserve your ports and maximize your gains, buying time is going to help you, and also less stress. Time is going to be the benefit.
Shoot, what's even better is when you buy something that's out like 2 or 3 months out. Like I have CRM calls for January. I was down 70% because we were trading at 136. But I was like, okay, no sweat. I still got till January. If I was in weeklies, I'd be screaming.
100%.
Yeah, but that you gotta also put in perspective though. For some accounts, it's very hard for them to see anything below -50. So you have to have both perspectives. Yeah, you may have time and the play can come back, but sometimes you just it's a narrative that can fit both situations. So you guys have to be kind of cautious with how you approach this.
That's true.
Yeah, I mean it's all your own risk tolerance and everything like that.
Yeah, like for example, remember Adex, we got into shop yesterday, you got out, but I was still in there because I bought time for next week calls.
Yep. Yep.
and I was up like 300%. I stayed in my play. Why? Because I had time.
Mm-hmm. I'm gonna start calling it the option trader method.
Adex, can you show the meta gap? I still think we had someone were asking about where you would identify the gap, please, sir, for meta.
Bro, meta's about to go off.
I agree.
If you look, I think there was large flow into like the like 110 calls or something like that. So
from 114.90 to 129.82.
So how come you're not using the candle or the body of that meta daily, the green one?
This
it already started.
Because it already started. Yeah, I started feeling it. Because originally the gap was from here, and so we already started feeling it.
Okay.
Yeah.
So it looks like it goes up to 129.
Yeah. 129.82.
Nice.
So you're looking at 130 calls. 130 calls for December. All right. Any other questions, you guys? I appreciate you all being here early in the morning for the East Coast. I know it's just hit the afternoon.
Wait, I
for
think
y'all.
I think we got one more coming in.
Okay.
I think complications.
Hey, y'all have a massive vacation coming down.
Should be asking one.
Okay, so this is not related to the class.
Oh, okay.
Okay. Any other questions? And yes, this will be recorded. Once it is done converting, I will make sure I'll have it in the lesson tab for you all. I think that was
Thanks, Adex. Great class, bro.
Of course. Thank you all for being here. I appreciate y'all. Thank you.
Appreciate that, Adex.
Of course. You guys have a wonderful rest of your Saturday. I'll be looking at some tickers today probably, but I'm probably not gonna have a watch this out for tomorrow. But of course, like, please post charts in chat. Let's see what we're looking at. And yeah, you guys have a great rest of your weekend. I'll catch you guys later. Peace out, y'all.
later.
Later.